Hello everyone, and welcome to another one of the NSCA webinar series, What Every Integrator Needs to Know. This is Chuck Wilson, Executive Director of NSCA. Now in our fourth year, these monthly webinars detail topics that are related directly to the business opportunities or challenges, issues, policies, things that people need to know about running a system integration company and doing so in an effective and profitable manner. So just for some housekeeping, all the participants are on mute. We do, however, encourage you to ask questions by submitting them in the chat box down on the lower right-hand side of your screen there. And we're going to be recording this, so anytime that you would like to watch this again, listen to it again, you can go to www.nsca.org/webinars, and we archive those and you can share those with other staff members as well. So to get things going, in today's webinar, we are going to address the age-old issue of capital. So as we know, every business needs capital and cash flow to survive and to thrive, but we've come up with some new options for our members, and some of them are very, very interesting. Today is one that has really piqued my curiosity, and of those who have tried this and used it, they have fallen in love with this new solution that we have. So we have a new affinity partner, Global Technology Finance, and they are a leading provider of what we call supply chain finance solutions in the technology marketplace. Today what we're going to do is listen to Paul Stemler, who's the president and founder of Global Technology Finance, and he's going to be our presenter, kind of lead us through what this supply chain financing is all about. So for the next, say, half hour or so, we're going to go through a presentation that Paul has put together for us, and then we'll have time for some Q&A at the end. So feel free, as he is going through his presentation, to type in your questions, and I'll moderate those at the end for Paul. So anyway, I'm pleased to have Paul Stemler with us today. So Paul, thank you for doing this, and I'll turn things over to you.
Hey, thanks a lot, Chuck. I appreciate the opportunity. We're not new to NSCA, but we're new to the. We are new to NSCA, but we're not new to the industry, and it's a great opportunity to really become an affiliate partner and move stuff through with you. By way of background, I am the president and founder of GTF. I was previously the COO, CFO of a company called Sarcom, which I landed in the late 90s. They are a very large system integrator, but they're doing around $600 million at 21 branch offices. And we really founded GTF in 1998 basically to optimize and solve our own capital needs at Sarcom. So I come from the industry, we understand intimately the problems, and really our solution was a solution for ourselves. In the early 2000s, we began offering the GTF solution to others. What had happened at Sarcom is we had decided this was working so well for ourselves, we really didn't want to share this funding with other people's competitive advantage. And then for a bunch of reasons, that philosophy changed in the early 2000s, and we were able to sort of create GTF as a standalone business and really offer supply chain financing in the technology marketplace on a broad scale basis. Since then, we've funded around well over 10 billion. I think we're probably at around 11 right now. Been very active in the last 15, 16 years. Our entire philosophy, starting with ourselves first, was to try to make our partners successful and make you successful. And we have and are investing millions with existing NSCA members in supporting their business and their growth through the supply chain. So we do understand this business quite well. We are in this business, and we've been financing NSCA folks for probably 10 years. I always like to start to say, who are we as integrators and what do we look like, and then can we make the capital support us so that we can optimize our business, kind of what Chuck was suggesting is what our whole trade association is designed to do. But really, at our best, we are fantastic sales service providers of leading technology solutions. That's our vision. We provide solution engineering, we provide product installation integration, we provide training and support. What we are not is manufacturers and distributors. And what we're really not is a bank. And for a bunch of reasons we'll talk about shortly, we're really a bad bank. And that's not really what we're ever going to be good at. If you look at how we operate financially and the constraints that our business as a optimized sales service company looks like, is we typically have high revenue. We typically have relatively low margins. We have revenue peaks and valleys. And that means that, sometimes a project can spike and our revenue goes up. We are in a dip while we're working on a project. We got quarter-end considerations where our customers are sort of demanding things get done by quarter-end. So 2 months are slow, 1 month's high, that kind of thing. We manage basically a lower net worth. As a sales service company, we're never going to have high net worth because we don't need a huge amount of capital investment, and nor can we obtain that capital as a sales service company. And then we also have to manage project and construction finance. That means percentage of completion. That means dealing with partial pay and slow pay. That means that we're going to have to make the upfront investment in the products to support our project and our customers to ensure delivery and timeliness. That's our box, financial box. And what we're trying to do is the capital doesn't equal that reality. If we're not capitalized to support that kind of reality, then we're not going to operate at our best. So what is an ideal capital structure, and what are the components that we really need to have in place? First, ideal capital means that 100% of the projects and our customers' needs are financed. We never run out of money or credit. We never fail to meet the customer needs. And we all know, sitting on the phone here, that if you got 90% of it done, you don't have the last 10% done, you don't get paid for the 90 till you do the 10. So you really need 100% financing to support these things. You need your capital structure. We need our capital structure to be manageable and flexible. That means we know we got ups and downs. We know we got peaks and valleys. We know we can get stretched out in the marketplace for various uncontrollable events. We don't want to be out of compliance with terms and conditions like covenants that cause a constraint on our capital. And we need to be able to manage through constraints that are uncontrolled by us. That could be a delay in delivery. It could be a marketplace issue. It could be a customer needs to change the schedule. The other thing about ideal capital for us is we need to be able to use this at our discretion to manage the supply chain. So what I mean by that is you want to be able to buy where you need to buy. You need to buy when you need to purchase and manage that timeliness so you can meet your projects on time. You don't want to be told where and when to how to operate. So you need the flexibility to bring your customer, our customer, the best possible solution and to do that in an efficient manner. And the last thing, which is very important, is ideal capital has to be affordable. If we're forced by excess capital costs to be non-competitive, we simply lose business and can't be successful. So looking at this, when we were at SARCOM 15, 16 years ago, we really founded GTF and supply chain business because we needed to be our best and we needed an ideal capital structure. And that's how GTF was designed. So we just sit back and say, what are my capital options today? What do I can go in the marketplace and get to get myself capitalized to be successful? And you really wind up with three mechanics. The first is you can self-fund. That means you use your own cash and equity and you use vendor credit. And that combination allows you to create an optimized capital structure for yourself that meets the objectives we just articulated. The second option is some sort of bank funding. That would mean that you'd use your own cash and equity. You would have a bank line of credit, which is supplement that equity. And here too, you have vendor credit. So that would be a middle ground. The third option is GTF, which is a supply chain finance option. And supply chain finance providers such as us, what we do is we provide 100% of the capital from the moment you place the purchase order to the moment it's collected. That's what supply chain finance means. So we're financing your entire supply chain from purchase order, vendor purchase order, to collection. And that allows you to save your cash and equity and save your vendor credit. So those are really the three options that are available to folks. If you look at the self-funding option, you have to have enough equity in your business. Examples of these kinds of companies are typically public, where they've raised a bunch of capital in the public marketplace, so they have investors, or many of them are VC-backed. And that means they've gone out to an institution, a venture capital group, something like that, to invest a significant amount of equity in the company. One member that we've supported over the years actually chose to do that, and he went out and raised about $10 million from an SBIC type investor. So the pluses, if you can get yourself in that situation, are you really have no bank, finance, or company fees. And vendor credit is mostly free. So, and you really don't have to deal with covenant or compliance concerns. You're not borrowing any money from anybody. You're pretty flexible. You're getting free vendor credit as long as you manage that, and you have no fees or expenses to deal with. The minuses are that you need lots of equity to do it. And a lot of times you look at companies and they have lots of equity or significant equity they've accumulated, but it doesn't really generate a high ROI because it's invested in the working capital chain where they could maybe take that money and reinvest it. But the money also remains in the company, not with ownership. It is very difficult to get your cash out of those situations because you're so dependent on that cash for your working capital, and it may not be particularly efficient. And of course, you must constantly manage and monitor vendor credit. Those lines of credit change. There's a lot of reporting and communications required, and you just need to be good at it and manage it. The bank funding option is probably where most integrators operate in this loop. And we think it's generally suboptimal. I mean, that's where Sarcom operated for a long time before he came up with GTF, but it can work. Here are the pluses. You do need some equity. You cannot get a bank loan usually with a negative net worth and no equity in your business. But it is cheaper than going out and raising third-party equity and can certainly complement existing equity that you do have in your business. And to get equity, you tend to have to go sell part of your business or somehow dilute your ownership if you haven't been able to accumulate it. So by leveraging your existing equity with a bank loan, you can tend to create enough equity to self-finance. The minuses are probably pretty obvious to most folks, but to some extent, you do have to have equity. This does not work if you're a startup, typically very well, or a smaller company necessarily, or one that's had some ups and downs financially. They don't tend to be as bankable. All banks have very significant terms and conditions that you have to manage to. That includes financial covenants. That includes personal guarantees typically. They must be carefully managed and monitored. You're going to have to, you got reporting every month. You need to have compliance with their documentation. You need to know what their documentation is, all those sorts of things. Again, the capital will stay in the business, not with ownership. Typically, that's mandated. In the self-finance model, you can choose to do that or not. You probably have to based on the business realities. But in this model with a bank, they don't want you taking the money out. In today's market, banks are just not that flexible due to significant regulatory restrictions, and they just can't be. Now, there is a continuum of banks to approach. If you're a larger institution, growing, you may be able to deal with a regional or more national bank. If you're smaller, you may have a community bank option or more of a local bank option to approach. Usually the more regional or local bank can tend to be a little more flexible, but then they can't give you a very big line because they're not big enough to do that. A regional or national bank will have bigger lines available, tends to be cheaper, but also much more restrictive. So that's sort of the continuum of where you are in the marketplace. If you're looking at bank funding in today's market, depending on the quality of your balance sheet, you're probably in a pricing model of borrowing somewhere between 3 and 7%. 3% would mean that you're very solid, long track record of profitability, well capitalized. 7% means, you know, maybe not as big or as well as you would like, but still bankable. They're going to charge more to risk adjust and to support the cost of management. The next option is a supply chain finance, the GTF model. Now in this model, the pluses are the following. You really need little or no equity because GTF is supplying 100% of the capital that you need. There's no line restrictions, there's no bad debt risk because when we take it on in our business model, we're assuming the bad debt risk. So that eliminates the capital, the equity capital need, and frees up existing equity capital to be reinvested in your business, perhaps in a service investment, or to buy another business, or to hire salespeople, or frankly just to take an ownership distribution. We manage the vendor payment and credit terms. We pay the vendors, therefore the vendors know that their payments are guaranteed. So when you call them up to manage a project with them, they're not starting the conversation, well, yes, but how do we get paid? It's, yes, we'd love to. We know we're getting paid. We're going to get paid very, very promptly and exactly per terms. So that enhances your ability to go market and get their attention and to do bigger projects and to have the vendors engaged. A vendor is always going to go to where they make the most money and it's easiest to do business with. And if they know that you're the guy that's paying them quickly, you have well capitalized, those projects and that support goes to you ahead of somebody else and positions you for success with that end user customer. Tons of examples of why that works. You will wind up, your business will have greater flexibility and be more manageable. The reason is you don't have to manage covenants and you typically do not have personal guarantees. So that gives you the flexibility to mix match and do what you need to do. In our case at GTF, our program is 45 days free. So the first 45 days of financing in the cycle, which means from the day it's shipped. Now when the purchase order is placed, from the day shipping, so it's with your customer to when it ultimately gets paid is free. Most of our accounts today turn their receivables in under 45 days. I think the corporate average is around 41 at GTF. So basically this program is 100% free. The minuses in this is there is some friction involved with that needs to be managed. First, the 45 days free is driven by vendor rebates and discounts. The vendors are supporting this because they're getting paid very promptly with no risk. But we ask that our partners work with us to maximize these rebates. And the leverage in the conversation is revenue that you bring, in other words, your purchase order, and our cash. Both of those things together, different times in the business cycle have more value. 5 years ago, cash was king. Today, revenue is king. But you can't get the discount without the cash, and we doesn't always get the discount without the revenue as a partner. And then GTF is engaged in transaction approval and supporting you. So we know what's going on with the customer. We understand the documentation. We're a partner with you in getting those things done, and we're working together to make sure this transaction goes very smoothly. I would say this. Some of the integrators, NSCA integrators, have taken advantage of this program, and they are vastly more successful at the moment than they were without it. And the reason is they have all the pluses have come back to them. They're able to buy and ship. They're moving the business forward. And I would also tell you that our financial IQ in supporting them with the process and things we've learned about how to be good at this has been constructive. And that means they make more money, they collect their stuff sooner, and they don't have their capital invested in this working capital chain, which, as you know, can be really quite an investment. What option is really right? Okay. Well, the right option has to be what's closest to ideal in your circumstance and situation. You need ideal capital to be competitive. If you can't buy right, you can't buy where you want to, one of those four elements is not in place, then you will not be as competitive as you need to be. And what that ultimately means is that you'll make less money, or you can't maximize the growth opportunities, and you cannot always serve your end user. And time and circumstances change. What you're looking at today may be different 2 years from now, and where you were 3 years ago is completely different. If you have lots of equity and profit and are feeling confident to self-manage, then self-fund. That is the cheapest, most flexible. You can manage it yourself. Maybe you want to have an insurance policy with a bank line you hopefully don't use, but you're in a very good position to mix and match and manage very effectively. If you have lower equity or low equity, but you do have good vendor credit, and you can tolerate T's and C's, a bank option can be workable. You're going to pay something for the bank. Like I said, it's 3 to 5%, 3 to 8%, whatever the range is, but you can make that work if you can stay within the confines of the box while you manage all the variables that go on in your business. If you're looking at this and thinking about it and you want more flexibility, you have lower equity, you'd like to have your capital be deployable as you choose to, and you're looking to get rid of the vendor constraints and have unlimited credit and those kinds of things, GTF is a great solution for you. We provide that. It's designed to be ideal, and it will be ideal. The trick to these things is to clearly evaluate your own circumstances and to take the action before you get stuck. It is so much more efficient to be proactive, to suggest that my business is growing large. I know in September I'm going to have big business. I've got large purchase orders. I had a bad quarter. All those things factor into it. But to get yourself ahead of time into a place where you can manage through the ups and downs of your business and have the capital in place. I like to tell people, stay out of the financial hospital. Don't get yourself in there. If you get in there, we're good at helping you get out. It's just a lot more work. So if it's a situation you're looking at, these things are nagging at you, time is now to explore your options, think about it, evaluate it, understand the transition costs, understand where you're going with it, what you want to do, not wait till you're kind of screwed and have to call Chuck. Our success stories are a lot. We work with many integrators. We have about $100 million in annual business over the years. We're currently partnered with existing NSCA folks and making some progress. We have gone through and have relationships with the AV vendor community. That means we do business with them regularly, we communicate with them regularly, we can pick the phone up and talk to someone regularly. That's very constructive in pushing volume forward and pushing larger projects. We also understand the contractor bid bond payment cycle. We're in it every day. We have an ability to support bid bonds, and we have that knowledge, which is critical, of how this stuff really works. In our industry, right, a lot of times you're doing business with a great end user like the, say, University of San Diego, to name one, but you're going through a contractor to get that. So we know we're going to get paid eventually, but we really got to rely and manage through that general contractor. And I would tell you unequivocally that our partners have become more successful because the capital is very aligned with their ideal, and they can go out and manage the revenue and the profitability. And many of them are in the 30+% revenue growth world. They're taking on larger projects. They're able to be aggressive. They have greater profitability, and they have positive cash flow. That's a nice place to be, and one that I delight in having someone tell me that we're in fantastic shape. What are the next steps as you sort of think about that? Well, the number one thing is to evaluate your business. If you're spending time on covenant compliance or worried about it, if you are dealing with sufficient vendor or insufficient vendor credit, I got a large order, but I don't know how I'm going to finance it. I don't want to take the order. I don't want to bid on it. If all your money and your entire net worth is tied up in your business, if you're not spending time on larger opportunities, those are the times that you need to think about, what do I do to fix my capital structure? How do I get myself positioned to eliminate the negatives, focus on the positives, and drive forward? At GTF, we typically get people's financials, send them to us. We model it for free, and we provide them a model and proposal that's appropriate. We probably do that once or twice a week. Been doing that for 15 years. So you get a lot of information. We're not always the best solution, but we're a solution. And sometimes they come back and say, look, what you're doing is going to work. It's not worth the transaction costs and friction. Just keep doing what you're doing. You'll make it work, and you'll be successful. So Chuck, that's kind of the end of the formal part of the presentation. And I want to open it up to questions.
Sure. Yeah, and that was an excellent job there, Paul. So what you do, if you have a question for Paul or myself, you just type it in the chat box, and I can read them right away, and we can go through a little bit of Q&A here for the next 15 minutes or so, let's say. And while we're waiting on that, I've got a couple questions that came in as you were talking there, so I can start with those. I loved your reference, by the way, to the financial hospital. So I guess let me start with my question what, and as you know, people don't call me until they're in the ER there at that financial hospital kind of thing, or in the ICU probably is a better analogy. But is there some metrics that I could share with our members to give them an indication of what we mean by that? Like, if their line of credit is at 80%, or if they're on, credit hold by more than one vendor. I mean, is there some kind of thing that we could say that, you're entering this? Or what I was thinking about is, what if they have projects in excess of X percentage of their annual revenue? I'm in a situation right now with a member that I'm actually trying to talk them out of bidding a project that is about equal to the size of their annual revenue. So imagine a company that's 15 million thinking about bidding a $15 million project, and I'm saying no, and their sales guys, they're like, hey, this could make our whole year. I mean, is that kind of like being in the waiting room of the hospital?
Yeah, if they're in the situation where you're doubling your business in a large order like you just mentioned, they will not typically have the vendor credit or the bank lines available to initiate that order. If they're in a supply chain world with me, we would say, go get the order. We're thrilled because we're relying right on the purchase order from the end user and the quality of all that for the credit, not relying on the integrator for the credit support. Mm-hmm. So we're looking at that transaction and saying the quality of that's fantastic. We love it. These guys done a great job. We're like, go get the order. We're thrilled. We're your partner. Here's the money. If they don't have a supply chain partner, then they're going to be in a constraint where the vendors and everybody else and the banks are trying to finance that for them, and they don't have the collateral technology to support that new large order and support that growth. I would say the signs on the trail for a guy to really stop and consider how they're capitalizing, if there's a better way to do it, or they're spending just an inordinate time on vendor credit, maybe on credit hold. They can't pursue a large opportunity like you just suggested, and they may or may not be, dealing with bank headaches. A guy just sees, you didn't have a good quarter, you're out of compliance, you didn't file out the forms, all those things are a headache. A lot of guys in our world, Chuck, that have bank lines, that's a good thing to have a bank line. What is a bad thing is to use it until you really need it. So you really want to have that, and we work in partnership frequently where We're doing the working capital. We're driving all that through. A guy's got his bank line in his back pocket, which has probably got a PG on it and stuff like that. But that's kind of like money in the bank fund. That's his little extra slush fund. If we do our jobs together, he doesn't really need to tap it, but he has it. And that's kind of a nice situation to be in.
Mm-hmm. Okay. Here's a question that came in: is what end users qualify and which ones don't? So, for example, you mentioned the contractor. What about our government? What about churches or people that may or may not have, where you don't have access to pulling a D&B or something like that? I mean, do you tend to favor certain types of projects and shy away from others?
First, all government entities, by and large, we finance. School systems, local governments, federal, it's all good, typically. We're also knowing at the end of the day, our collective source of repayment it may be coming from a general contractor. So we will diligence that contractor along with our integrator partners to make sure this guy can pay. And if we're worried about some aspect of that, then we need to communicate or figure out how to just make sure we don't get nailed with a bad debt someplace, which is just horrible. And then other accounts, the churches and so forth, we go in the marketplace typically and use third-party credit insurance, as a credit supplement, mostly to get access to their databases and their information, which is way better than D&B because these guys are putting their money on the table with us. And they're using our balance sheet to support these situations. So we'll go and look at something. We may not have them in our database necessarily because we've been doing this for so long. We do have a lot of approved accounts, like 6,000, 7,000. But we'll just work together, get this thing credit approved, get it figured out, make sure we're not going to get screwed in collections and move forward together. So we look at it as a partnership to get it through. Don't forget, if we're financing the product, that's one aspect of supply chain. A lot of times integrators are providing, the services and the other work. You don't get paid in the services. That's really bad too. So we're both partners in making sure this gets done. And I tell people when they ask this question, I said, look, we only make money in our model if we actually sell and ship and transact business. We're not a bank that sits there and collects a fee. We get a fee as a percent of the revenue. Even with the 45 days, that's how we're managing our profitability. So we want to get the deal done and moving forward. And our model is just as much as the integrator. So it's it's kind of a work together thing to make that happen. And luckily, over the years, our bad debt experience has been very, very good and very strong, and none of our integrators have lost money. And so it's been a positive.
Yeah, I was telling you once before, and I got another question along the same lines, that a lot of our members are getting to be our age. They're in their late 50s, some of them 60s, some even in their early 70s, and they just basically are like, you know what, I don't want to sign any more personal guarantees, and the banks are killing me with these now. The collateralization of the loan or the LOC is something that they just don't want to do anymore. And to me, I think, I'm sure you would agree, that this seems like a reasonable way to just kind of phase out of that and to get that LOC to be used for other things, right? I mean, that's the whole idea here, isn't it?
That would be, Chuck, exactly on. A lot of times, guys look at this and say, I've built a good business, I can self-fund, but I really don't want to have all my capital tied up in this business at risk all the time, and it's time to get some out. It's time for me to deleverage or, improve my own personal, net worth or, personal financial situation and, diversify a little bit and some of those other things. And we're a very, very good partner to facilitate that with.
Yeah. Hey, another question somebody asked me here is, do you need a relationship with the suppliers? So GTF, do you guys have to know, like, let's say one of our integrator members has like their top 10 suppliers that are their highest volume or distribution company or whatever, do you guys have to have a relationship with them in order to figure out the rebates and discounts and all that, or how does that work?
Well, we probably have a payment relationship with those guys already. Just because we deal with probably up to 650 technology vendors currently, and that list is always changing. So we probably have terms and conditions. They know who we are. We're set up to pay. So if you're an integrator, we'll notify those guys that we're in the system. Here's the payment, those sorts of things. Where we partner with our integrator partner is to get the discount terms negotiated, and typically that's we order this much and do 10 million with you. We're going to a GTF financing model. We're going to pay promptly in 30 days, and the discount for doing that is kaboom. And that just gets negotiated, right up front. In our space, there's significant amount of discounts for prompt payment available, and I think a lot of the manufacturers in our space are very anxious to sort of get that payment issues off the table, and we, basically are passing that right through to our integrator partners in the form of free financing, and so it's kind of a win-win for everybody.
Let's talk about rebates specifically. So we got the discounts and we get that, the 2% 10 days or whatever they have on the front end of that to get their cash quicker. But also on the rebates now, some of the bigger companies and more of the IT slanted ones, they have a tremendous and a very sophisticated rebate system, as you know, and some of our members really work that, and some of them don't have people or don't have the time, or a preferred vendor program or something that enables them to staff it and have buyers that are evaluating that all the time. So, but some of them are concerned that those rebates, or I guess what I'm concerned with more than they are, is some people are mistaking their rebates for added margin. So they're saying we can use those rebates in order to be more competitive, so they talk themselves into believing, hey, we can discount that, pick up the order, use the rebates, and they end up working themselves into a big old hole here. Is what they end up in the ER, So what? How do we help them rationalize that giving up those rebates in exchange for a better cash flow management strategy is a good thing? I mean, that's a heck of a question.
I would say there's really two kinds of rebates available. The rebate we're talking about in our program is strictly financial. So that's in addition to the volume incentive rebates, the meet the deal rebates, whatever the Azure managed marketing kind of rebates that are out there. Our deal is a financial rebate. So that's distinct. So in our model, we say, look, the vendor is trading off getting paid with certainty sooner and providing basically a subsidy to get that done. And they're willing to do that all day in exchange for getting the revenue and the relationship and everything else smoothed out. The rebates that you're talking about, the marketing rebates, the volume rebates, the program rebates, the education rebates, go to the master's rebates, all that stuff, those are usually very separate and distinct, and our integrator partners, work those every single day and, with varying degrees of success and perseverance. We would look at those, and we are willing, if they're confirmable, to actually finance against those rebates, because sometimes they can be, like you said, $1 million. It could be real money, and there's a timing associated with that. So we do look at those as part of the aggregate collateral and supporting a purchase order finance, a transaction, and helping the integrator manage that. So as long as they're verifiable. So we look, there's really two sets of rebates here that we're managing, and a lot of times integrator partners just don't have access to the financial rebates, so they don't have the capital to go get it. Or they may not know about it, or go fight for it, and which we do. We're in this business every single day, and that's what we do. So I think that was hopefully, kind of an answer.
Oh, that's a great answer. And I'm on record one way or the other on this deal, I guess. For some people hate what I said about this and others love it, but I'm on record as hating every spiff program that I've ever seen. And the manufacturers cringe when I say it, and they keep doing it. And sometimes the owner of the companies and the management know about them, and other times they go straight to salespeople, and it causes all sorts of bad decision making in my world anyway. But anyway, you're not talking about transferring any spiff dollars or any marketing type incentives if you move the closeout products or whatever they're doing? I mean,
Right.
when you said just the financial things, how can I help explain that to people?
Well, I would say the SPIF programs are the SPIF programs. And, like you said, they're always changing, and, all the issues that, go on that you just mentioned in terms of managing them, et cetera. Our program with a vendor is a finance program, and that's just, these terms are locked. They don't change. This is the deal. GTF honors that deal on behalf of our integrator partner, and that's what we do precisely. And that's just the terms. So it's kind of like the terms and conditions around payment are this. Most get negotiated, and if we made better by working together with an integrator, we do. If we are where we are. But the SPIF is managed completely separately. Usually within a manufacturer or partner, manufacturer vendor, finance is finance, SPIFs are marketing. Sometimes they overlap them a little bit, but it's you just got to dig it out with them. And like I said, we're pretty good at that. We have a lot of finance leverage.
Okay.
Our program really, Chuck, is try to just be transparent. As an integrator, you need to know that, capital is capital, spiffs are spiffs. We're not hiding anything, so everyone knows what we're making, And I always, when we designed the program, I just didn't want to have a, where I was like, what's my finance guy making, off of this, I mean,
Yeah.
we just tell you, it's right there. And, people can make their decisions or are aware of it. And I just felt that was just a healthier way to run the business.
Yeah. One thing that was extremely attractive, why we really wanted to partner with you in the first place, is you're one of us. You're an integrator. You get the integrator concept. So having a former integrator as a capital provider to our members makes a tremendous amount of sense. And case in point, you helped one of my good friends in the business that, they were in the ICU, I would say, at least in the hospital there. And what was so interesting about that is they had to make job decisions, they had to make vendor selection decisions, they had to make a whole lot of day-to-day, what keeps them up at night things before we met you, and now their life is so much better and they're able to do the business that they want to do. We took one of the nation's largest banks out of the equation. They had been moved to that special we have several members with using the same bank, and many of them are in that special projects or special programs unit where they take their friendly banker and all of a sudden, he or she is gone, and now they're working with, some group in New York or Phoenix or wherever they might be that has them on, where they've, putting the squeeze on them on their covenants in a big way. And so, doing things like this that gives our members an alternative to tying up their own, what is basically their retirement money or their personal net worth, or, staying awake at night not knowing if the bank's going to come. We had one of our members that all of their employees showed up for work on a Friday at 8 o'clock, and the banker was there with a padlock and a chain around their front door. They couldn't get in. And so I don't ever want that to happen to anybody again, is what I'm rambling about here,
Right.
Paul, is I think I think if we can develop those metrics and get our members to come forward that are struggling with these kinds of things before they're too deep on that, where we wouldn't have to go through what you just did with another friend of ours there. So that's what I guess I'm encouraging people to do, is to give you a call. Your contact number is up there, both in Ohio and now where you live, and just talk this through. You know, if there's a situation that, you know, you're worried about giving up the rebates or the, you know, the early pay discounts, but yet in the long run you're up all night, you know, worrying about the bank line and stuff, and being on credit hold, then, you know, something's got to give. So anyway, I rambled on almost to the end of our thing. One quick question though came in. Are you actually then placing a lien against the accounts receivable then? Is that really
Yes.
how you yeah?
Yeah,
okay.
we basically, on our credit construct, we take control. I mean, when control is not the right word from an operational point of view, but from a legal lien point of view, that purchase order from the end user, the general contractor, the, you know, facility, whatever, church, whatever we're doing, that becomes the collateral for the supply chain, for our ability to finance the whole supply chain. So we're saying that purchase order comes in for, say, $1 million, you know, from Merck or what, you know, pharmacy or something, and they need to go buy $700,000 worth of stuff, $100,000 worth of services, you know, that kind of story. That purchase order is our collateral, so we follow that through and have a lien against that purchase order to the end, and that's really how we're able to do that. And we're not relying so much with a general lien like a bank does on the assets of the business. We're really relying on the quality of the end user in that purchase order.
Excellent. All right. Well, that wraps us up for today. Here, we're pretty much out of time. Again, the other great thing about these webinars is you can go to our archive list on our website. Just go to the webinar tab, and you can look at all of these that we have done over the last 3-4 years. So anyway, terrific job, Paul, and I'm really excited about our new partnership, and you guys will be at our events that we do and everything to explain it more. So anyway, thank you for your time, and thank everyone on the call today for their time as well today. So great job, and I look forward to a long partnership.
You know, Chuck, one thing just occurred to me, which is a question. I'm sorry to jump off, but on that end user issue, the end user doesn't know or sign anything. When we're saying relying on the lien and credit, we're not going to them and asking them to assign the document to us, so that customer relationship. I mean, it's completely transparent to the end user and to the vendor.
Yep, excellent, excellent, good point.
Yep.
All right, well, thank you so much again, and we will be talking shortly.
All right, thank you, Chuck. Thanks, everybody.
Thank you.